Absolutely. I think over the short term, investors are focused on this policy divergence between the Fed and many of the other major central banks. That's been brought on really by the conflict in Ukraine. The US economy is a lot more isolated from that than certainly the European economies. The Fed is now expected to raise rates by 50 basis points over the next 4 meetings. Also to start quantitative tightening, $95 billion worth of assets coming off the balance sheet, probably from June onwards. So the markets are fully aware of what the Fed are doing, and it's certainly more aggressive than elsewhere. So in that context, over the short term, that divergence story persists, and I think the dollar can continue to strengthen going forward. Over the summer, though, the equity markets now are beginning to dislike this. 7.5% drop in the S&P 500 since towards the end of March. The US economy is beginning to slow. I'm not sure they'll deliver 4 50 basis point rate increases. I think they'll have to slow down the pace. Then the dollar could start to weaken, but the window now is definitely there for the dollar to strengthen further. Well, if there's any foreign exchange pair trading on this divergence story that I've just mentioned, it's dollar yen. And indeed, by the end of April, if we get to around 130, dollar yen over a 2-month calendar period will be up 13%. That will be the biggest move over that period since 1995. So certainly justification to talk about this. And indeed, Finance Minister Suzuki has spoken about watching foreign exchange rates with a greater sense of urgency. And of course, in the G7 agreement, excessive disorderly moves are undesirable. So therefore, there is the justification to consider this. Now, we do have the Bank of Japan meeting this week, and there is a small chance that they could change their monetary stance. And that could open up the potential for intervention. But I think at these levels, it's very, very unlikely. And I think you would have to get a sharp move through 130, and those very excessive disorderly moves at those levels could prompt some form of action. But I think at the moment, it's quite unlikely. Well, I think that is pretty debatable, to be honest. As I said, the fundamental story is still quite compelling. And if US rates are moving higher, or if the Fed is becoming more hawkish, the BOJ maintaining its current policy stance, I think the chance of intervening successfully and driving dollar yen lower would be extremely limited. Joint intervention, of course, is much more powerful than Japan intervening alone. But of course, there's no way the US Treasury is going to instruct the Fed to sell US dollars when the Fed is raising rates aggressively to fight inflation risks. So that's a no-no. Japan intervening alone, of course, is possible, but I think you'd need to see some change, either a drop in US rates or a change in stance from the BOJ. Without that, I think intervention alone from Japan is very, very unlikely to be successful.